Hello, everyone. I'm Serge, and I've been working in sustainable finance and the development of the taxonomy for the last 4 years in DG Klima. I've also worked on mainstreaming in one particular financial program called InvestEU in DG ECFIN. So, next slide, please. I just want to cover a little bit how we finance our green transition in the EU. On the left side, we have the public finance side. All right, on the right side, we have the private finance. We have one big objective, 1 trillion euros dedicated to climate by 2030, and a target, 30% of the budget, 30% of Next Generation EU dedicated to climate. We'll go into how we calculate the part that goes into that is considered as climate spending later. There is essentially two sides to the mainstreaming. We do the climate tracking of each individual programs, and so you can see the programs on the left side. We have the NDICI, we have the RRF, we have the CAP, and then we also have a second side, which is what is the minimum environmental standard for each environmental program? What are the things that we will not spend on? We call that now the do no significant harm principle, and it's also mainstreamed in the budget. Just a little fact, the Common Agricultural Policy is the biggest contributor to our climate targets, because it's also the biggest part of the EU budget. Now, having said that, the part on the right is very important too, because public finance cannot be the sole contributor to our green transition. We need to reorient private capital markets, leverage investors to invest in the green transition. So yeah, that's the part that I am going to cover a little bit before going back to the mainstreaming of public finance. Next slide, please. So in 2018, we figured we really need to start looking at, okay, can we make financiers invest in the green transition for us? Because we can't do everything on our own with our budgets. So we developed a sustainable finance action plan. That sustainable finance action plan had 3 objectives: reorienting capital flows towards sustainable investments. Essentially, that's the main objective, but the other objectives support that. It's pretty holistic. In order to reorient or to give an incentive, we asked them to manage their financial risks, to take into account or better identify the financial risks that come from not considering climate and environmental factors in their investment decisions. And the third part is long-termism. Okay, if you have a very short-term investment horizon, as many investors do, you're not going to consider climate change, which is a longer-term issue. And of course, transparency. So in that context, we thought, well, we need to do all this, but investors do not know what is green. How can we ask them to reorient their capital if they don't even know what is green? So we needed to define a taxonomy. Can we go to the next slide, please? Okay, so what's a taxonomy? It's a classification of economic activities on the basis of whether they're sustainable or not. So for each economic activity, we define sustainability criteria that if a corporate that undertakes one activity complies with the criteria, that activity, so the turnover it generates from the activity, the spendings that go into the activity, are considered green. Okay, so what do we ask the companies? We don't ask them to invest in the taxonomy or to undertake activities in the taxonomy or to comply with the taxonomy criteria. That would be essentially, that would be forcing them. We don't do that. We ask them to report, though. We ask them to report on the shares of their business that comply with the sustainability criteria. So the shares of green turnover, of green spendings, and yeah, so it's essentially a tool of transparency. It does not rate companies. It doesn't tell you, okay, this is a green company. It tells you this is the share of the company that we can identify as green. So we ask the companies to report, only the large ones for the moment, but we're progressively enlarging the scope. And we're asking the financiers also to do that reporting. So when financiers invest in green companies, we want them to tell us, and banks as well, okay, what is the share of your portfolio that is invested in green companies? Yeah, exactly. So next slide, please. So what is our methodology to consider what is sustainable at economic activity level? So for each economic activity, we define sustainability criteria. We have two criteria. Substantial contribution criteria. So an activity has to substantially contribute to one objective, to one environmental objective. And at the same time, it has to do no significant harm to all other environmental objectives. So for each economic activities, we define substantial contribution criteria and do no significant harm criteria. And then there is a final part, which is the minimum social safeguards, which is essentially a due diligence over the supply chain. It's an implementation of the UN guiding principles on large corporates. We ask them to look at their value chain and see, okay, are there sustainability risks that you have identified, and if so, do tackle them. But we have not defined criteria for minimum social safeguards. Next slide, please. Okay, there I wanted to show you an example of the criteria that we have. So this is the criteria for substantial contribution to mitigation. I failed to mention, we have 6 environmental objectives. We have 2 for climate, so mitigation and adaptation, and 4 for the environmental objectives, which are water, pollution, biodiversity, and circular economy. So we do try to prioritize the economic activities so that we choose to which objectives we will define substantial contribution criteria for. So this is for substantial contribution to mitigation for the activity manufacture of aluminium. Hopefully it will speak to everyone. So on the first part, we define what is a primary aluminium. So primary aluminium is new aluminium. And for new aluminium, we set essentially a threshold or several thresholds that that a corporate that manufactures aluminium has to comply in order to be green. So the threshold is, okay, if you produce aluminium with this much emission per ton of aluminium, 1.4 ton of CO2 per ton of aluminium produced, that's good. If you produce it using energy that is less than 100 grams of CO2 per kilowatt hour, that's good. And with a certain energy efficiency, that's exactly it. So we asked the companies to comply with the criteria or to report on the basis of whether they comply with the criteria. And that's for primary aluminium. If you produce recycled aluminium, you're always substantially contributing to mitigation. That's how we defined it, because recycling aluminium is much less energy intensive. So already recycled aluminium, its footprint is 80% less than primary aluminium. And we have defined criteria like these for forestry, for buildings, for energy, for transport, for nature restoration, for water and waste, for a lot of sectors, not for agriculture yet. And sometimes the criteria are quantitative, like these ones. Sometimes they're not. Sometimes they're process-based, practice-based, and it can get a little bit more complicated. Next slide, please. Okay, so very quickly on that one, just to give an idea of how the reporting works. You have a company, you disaggregate the company into different activities, okay? And the company will have to disclose the final share of green by looking at what is the percentage of the company dividing it by its activities, they're green. And then you just do a weighted average and you get the final share of the company that is green. Next slide. We're coming back to mainstreaming. So historically, we haven't used the taxonomy for mainstreaming. Why? Because the taxonomy is just appeared now, where we have been developing for the last 4 years. It didn't exist. So what have we been using? We have been using the Rio markers, or an adapted version of the Rio markers. How have we adapted this version of the Rio markers? Say, okay, if your spending, your intervention field, is expected to significantly be related to climate, then 100% of that spending can be earmarked as green. If only a moderate amount is expected to contribute to climate, it's 40%. And if it's not relevant, it's not material, it's 0%. But that system is valuable, of course, particularly if you don't have any other system, but it's not really precise, and you cannot use it to define minimum environmental standards either. It can only do tracking, no defining minimum standards. So the risk, so when we started developing the taxonomy, there started to be a risk that there would be too many different standards that we would be using. Certain programs that we carry out by asking corporates, by asking banks, financiers to use the taxonomy. When we ask them to use the taxonomy in general, and we would then be asking them to use this system, the markers system, when they do climate tracking with us. That's very, very weird. We would then be putting two models on the market, and it's confusing. So now we're starting to think a little bit more than the system. We're starting to think again on the system. Yeah, the European Investment Bank has already given up on the system. They're already using the taxonomy. For their climate tracking, their target is 50% of 50% of all their investments have to be dedicated to climate, and they have to comply with the do no harm principle for all of their investments. So next slide. So in that context, how do you use the taxonomy, or why would you want to use the taxonomy? First, because yeah, you can use the do no significant harm criteria to some extent to define minimum environmental standards and to identify what would be harmful spendings. The second part is that it's actually quite a flexible tool to use. Okay, you have criteria. Maybe you don't necessarily want to replicate them because they don't necessarily fit your priority. They don't necessarily fit the model or the framework of your investment program. Okay, use the taxonomy for inspiration. You don't have to copy paste every single part of the taxonomy when you do climate tracking or you apply the do no harm principle. The taxonomy doesn't only look at climate, it looks at many objectives. And at the end of the day, with the taxonomy, you have defined criteria, whereas for markers, you don't have any criteria. And of course, yeah, it creates, if you use the taxonomy in the context of public spendings, knowing that private actors will have to use the taxonomy in their sustainability reporting, if you use it in your public spending, you can support them a little bit more with this new tool. Having said that, there are challenges, and we're going to look at them briefly in the next slide. So here I just want to for you to have some questions to ask yourself if you consider developing a taxonomy and using it for in public spending. Okay, do we know what the beneficiaries are? Who the beneficiaries of your program are going to be? Are they going to be SMEs? Are they going to be in what economic sector? If they're going to be in the agricultural sector, but your taxonomy doesn't cover agriculture, well, don't use the taxonomy for this particular program. So how large is the beneficiary is also a factor. That's what I said. Who implements the program? If your program is implemented, as it is for us in many programs, where the instrument, we're not directly managing the money. We're we're giving it to banks, who is then probably giving it to another bank or to another fund, and who will then invest in the company. Or we're giving it to the member states, who is then going to give it to a bank, who is then going to manage the money. You know, that's the nature of yeah the EU. It's difficult to then know exactly where the capital is going to go. If you're in that kind of program, probably the taxonomy is not the best tool to use. It's too granular. Now, okay, is your program going to finance economic activities or companies? That's a big difference. If you're, or is it even going to finance things that are not at all classified in the taxonomy? For instance, the RRF, a resilience facility, is finances fiscal measures sometimes. Fiscal measure is definitely not an economic activity. Yeah, if your program is more grants based than guarantees based, I can assure you that using the taxonomy is better. Why? Because if you give free money, well, you can ask more from the people who you give the money to. Whereas if you ask for repayables, if you give guarantees and it has to be repaid, okay, it's a bit harder to ask for such strict criteria to be used. If it's free, yeah, you can ask more. The same logic, if it's equity based financing. So if you own the company, essentially, then you can also ask a little bit more. You know a little bit more, particularly if you own a lot of the company. If you're private equity and you have a majority share in the company, you can definitely ask the company to go in a more granular level. If it's just a tiny investment, again, don't using the taxonomy is probably too much. It's a bit disproportionate. In the same kind of logic, if you're using debt, if you're using a green bond, you have to have a framework for green bonds where you know exactly how the money is going to be spent. If it's a project bond, you know exactly what kind of project you're investing in. In that kind of system, it's very easy to use the taxonomy because, again, you have access to the data. You know what you're going to finance. That means that you can already check in advance how to use the taxonomy or how it can be a factor in the development of the project or in the development of the financing structure. And the final consideration is, how good is your taxonomy? If you have criteria that are not necessarily so comprehensible, and that is a little bit our experience sometimes because it's the beginning and it's a difficult job, you don't want to use the taxonomy too quickly. Just wait a little bit and use it when you think it's ready. And with that, I think I'll leave it there. There's a final slide that recaps, if you want to move to it, the timeline of the development of the taxonomy, but I don't think you need that. Thank you.